Good day, students. I will be doing the 2013 November exam with you now, which is the one before the last exam video that I will do with you. We have, as if you compare these previous exams that I've done videos for, they are so similar, they have the same structure, they ask similar questions. The only difference is only numbers, and if you have went through all other previous videos that I've done, you'll see that there is honestly nothing new even in this question paper. However, still important for revision. We have the first question being question 1, that says Peter and Paul have been operating a close cooperation called Peter Paul CC for the past few years and have a 55 and 45% members interest respectively. We are given the trial balance for this close cooperation. I will just highlight one or two things that are important in this trial balance. We have the property, which might be important if there is a revaluation. Retained earnings is the opening balance. Take note of that. We also have a loan that bears interest at 15% per annum, and that loan is sitting at 450,000 rands. We have, very importantly again, SARS provisional tax payment 67,500. This is important because when we want to calculate tax receivable or payable to SARS, we use this amount and we compare that with the tax expense. And we also have members contribution, which is the total of 450,000 rands, being the sum of the contributions that were made by the members in the previous accounting period. And we have allowance for credit loss on the first day of the year, 1st January 2012, and that allowance for credit loss is 8,250. And you'll see that we have to compare with the allowance that we will calculate at the end of the current year. Then, very importantly, once again, we have prepaid expense. Remember, any expense that is prepaid by the beginning of the year, 1st of January, in this case 2012, any prepaid expense, which in this case it must be added in the expenses of the current year. That means our rent expense that we see here as 27,000, we have to say plus 2,250 because it was prepaid last year but paid for the current year. Therefore, now we must account for that expense or add that expense in the expenses of the current year. Then after we continue checking, we have loan to members, which is 75,000 rands, a loan to Peter, and 22,500 is a loan that was to Paul, and the total of the loans is 97,500. All the loans were given to the members. Now we don't know if is there any interest to these loans because it's not specified here. However, we'll see if there is interest or not. There is revaluation reserve on the first, which is an opening balance of the revaluation amounting to 150,000 rands. Just to highlight one of few things. Yeah, then after we have the nominal section from the sales until water and electricity being an expense. We'll account for that when we do the statement of comprehensive income. So now, as usual, and as I always advise my students, that after you have checked the trial balance, don't go to the notes or don't go to the additional information. Check what is required so that you know what you are required to do before you read the adjustments, so that we can structure the answering of the questions. Then we have the first requirement number 1, that says prepare journal entries to adjust the interest expense on the 31st of December 2012, as well as the closing transfer to the profit and loss account. consider only note number C, dates may be omitted. So now I will definitely do that. The second requirement is to prepare the following ledger accounts: asset disposal and accumulated depreciation. That one I will not do, as I have mentioned previously that asset disposal this year was done last term and you will not be tested on that in this term. Then we have requirement number 3, where we are required to prepare the rent expense account. This is always important to know how to prepare a ledger account for an expense where, more especially, there was a prepaid expense by the beginning of the year. If you remember here, there was a prepaid rent expense of 2,250 that I said need to be added under the rent expense for the current year 2,250. Remember, that will be in the form of a reversal. So now make sure that you understand how to do a ledger account where there's an opening prepaid expense. Then we have requirement number 4, where we are required to consider all the relevant information and prepare the statement of comprehensive income for Peter Paul CC for the year ended 31st of December 2012. So now the statement of comprehensive income is always important. Requirement number 5, consider all the relevant information and prepare the statement of changes in equity of Peter Paul CC for the year ended 31st December 2012. That will have to be done. Then the next one is to consider all the relevant information and prepare only the current liability section of the statement of financial position. That I will not do because you don't do statement of financial position this term or in this final exam of 2016. Then number 7, we are required to prepare the statement or to prepare the following notes to the financial statements of Peter Paul CC for the year ended 31st December 2012. Members interest-free loans. So now we know that the loans are free of the interest. That one I will definitely have to do. Number 8, consider note I and all other relevant information to do the following: calculate the value of Paul's 40. That one I will not do. Then now these are the only requirements that I will take into consideration. And whenever students, you are required to do the statement of comprehensive income, just like here. Whenever you are required to do this statement, make sure that you start drawing the rough draft, take into account all the expenses that are already given and the incomes in the trial balance. So now I will just start with the skeleton so that when I do my notes or when I do the additional information, I just copy and paste the amount from each and every transaction that I will be doing. So now I will start with my sales and obviously cost of sales and do that in the income statement. So now starting with the income statement, we say statement of comprehensive income. Remember, that is an abbreviation for the year ended 31st of December 2012, because we are doing the books for the year that end 2012. Then we start with the sales. Then after we subtract our cost of sales. And our sales in the trial balance are given to be 1,677,500. 1,677,500. 1,677,500. Then we check our cost of sales. Cost of sales amount to 975,000 rands. Cost of sales amount to 975,000 rands. Let us check if is there any maybe amount that will affect our cost of sales. Not any amount that affect our cost of sales. So now we record that cost of sales 975 thousand. No, something went wrong here. We are not here. Our cost of sales, this is not where we are. Okay, I don't know what happened. Okay, our cost of sales is 1,035,000 rands. 1,035,000 rands. Then we record that 1,035,000 rands. So now that will be our cost of sales. So this is where we are. Then from the cost of sales, we will get to the gross profit. Then after we say gross profit, our gross profit will be sales minus cost of sales, and sales minus cost of sales gives me 642,500 rands. Then after we have other incomes. So now under other incomes, if you want, you can record interest on loan to if there is interest on a loan to. Interest on loan to. But in this case, the loans were free of interest. So now there's nothing to worry about the other incomes. However, you must know that interest on a loan to can also be recorded under other incomes. Then after we go to expenses, and we record our expenses as they appear in the trial balance. And the first expense that we have, remember, interest expense on a loan, that will be after all the expenses. That will be a finance cost. So that will be the last one. Just take note of that so that we don't forget. The first one is the credit losses, and the credit loss amount to 7,500 rands. So we have our expenses, the first one being credit loss, and credit loss being 7,500. And I don't write the expenses under total because there might be a need for an adjustment when it comes to expenses. Then I record the second expense being rent expense, and the second expense is rent expense, and our rent expense is 27,000 rands. Rent expense is 27,000 rands. Our rent is 27,000 rands. Then we also had another rent expense that was in the trial balance, and that rent was prepaid rent of 2,250. And I said that a prepaid expense in the beginning of the current year, you plus that in the expenses for the current year. So now that 2,250 must be added here, 2,250. So now, even without going further, let me just analyze. Okay, I don't know what is happening, why this is always moving up. So now we just have to analyze this trial balance. And in this trial balance, when we analyzed, we looked and we have seen that there is a prepaid rent expense of 2,250, and there's a rent that was already paid, which is 27,000 rands. So now I just want to analyze this before we go to the adjustment, so that you are able to interpret this without any adjustment. So now last year we had a rent expense of 2,250, and the rent in the current year is 27,000 rands. Okay, so now we have to check if was there any prepaid by the end of the year or not. So that will help us when we go to the adjustments. Let me leave that one so far. The next expense is wages, and our wages is 62,750. Wages 62,750. 62,750. There might be an adjustment, I don't know. So let me leave it like that so far. The next one is salaries to members, 180,000 rands. Salaries to members. Remember, salaries that are to members are recorded in the income statement just as a normal expense. Salaries to members amount to 180,000 rands. The next expense, then this thing goes again upwards. I don't know what is happening now. The next expense that we have after salaries to members is water and electricity. And water and electricity is 31,500 rands. Water and electricity 31,500. Water plus electricity. Electricity 31,500. There's another expense that is here which you don't have to calculate, which is depreciation. I will just give you the amount for depreciation, which is 78,750. And I've been always telling you that when it comes to depreciation, don't worry, because you were tested on depreciation, and in this test you will not be doing the calculations regarding depreciation. So now hence I don't want to waste time calculating depreciation for you. Then now we have accounted for all the expenses that were supposed to taken into consideration. So now let us straight go to the next part of the income statement, which is the finance cost. After the expenses, we get to finance cost. Then we say finance cost. Finance cost, remember, that will be interest expense. And we do have interest expense that has already been paid. And our interest expense, sorry guys, this technology now is always moving up for a reason that I don't know. The interest expense that we have is given as 61,875. 61,875. So now we record that 61,875, 61,875. So now there might be an adjustment to be taken into account. Then we will get to the profit before tax. Profit before tax. Profit before tax. Then after we have to subtract taxation expense. Taxation expense, and our taxation expense will definitely have to be negative, so as our finance cost will have to be negative. Then we get to profit for the period. Profit for the period. Then that will be the profit that will go to the statement of changes in equity under the retained earnings column. So now we have completed the structure of the income statement. Then we can go to all the adjustments that we have. So now the first adjustment in this exercise says that Peter and Paul contributed towards members' contribution according to their members' interest. There were no additional contributions during the current year. So now it means the amount of the contribution that we see in the trial balance, the contribution of members' contribution of 450,000 rands must be split using the members' interest of 55% and 45%. When we do the statement of changes in equity, you will see all of that. Then after we go to number B, this is statement of changes in equity. Number B says property was revalued on the 31st of December to a fair value of 1,275,000 rands. And in the trial balance, we had the value of the property at cost as 1,125,000 rands. So now we have to say 1,125,000 rands minus 1,175,000 rands. So now we have to subtract that to get to the revaluation. Then the statement of changes in equity. I don't want to forget, just to take note of that. Number C says prepare for the interest expense payable on the mortgage loan for December 2012. On the 1st of January 2012, 75,000 rands had been repaid on the mortgage loan. The next installment of 75,000 rands is payable on the 1st of January 2013. So now the next payment will take place one day after the end of the current year, because the current year ends in December, which is 31st of December 2012. This is the end of the current year. And the following day, a payment of 75,000 rands will take place regarding the long term or the mortgage loan. So now it means that will be recorded as a current liability in the statement of financial position. However, we will not be doing the statement of financial position. We are only doing the income statement. So now in the income statement, we need to account for the interest expense. Interest expense that is payable. That means there is interest expense not yet paid by the end of the current year. So now, if we look at the mortgage loan, 15% mortgage loan of 450,000 rands. Let us calculate that. Calculating interest that is payable. That means the close corporation paid less than it's supposed to have done so. 450,000 rands times by 15%. And if we say 450,000 rands times by 15%, that should give us 67,500 times by 15%. That gave us 67,500 rands. So now 67,500 is the interest that was supposed to be paid. But if we see in the trial balance, an interest of 61,875 was paid. That means we paid less than what we're supposed to have paid, minus 61,875. That is the 61,875 that we paid. So now it means obviously the difference will be accrued, and that difference accrued will be 5,625. 5,625. That will be accrued interest expense, which is a liability. So now, based on the requirement, because another requirement instructed us to do a general entry, that was requirement number 1, because we already know the requirement now. We are required to do a general entry and also do the closing transfer to the profit and loss. So now we have to do a general entry for the accrued expense. And when we do that, we will debit interest expense, because interest of 5,625 was not paid. Interest expense 5,625. Then we credit accrued interest. We credit accrued interest. And this accrued interest is 5,625. Remember, accrued interest is a liability. Accrued expense, in fact, is a liability. Then after we do a closing transfer, in the closing transfer, we have to debit our profit and loss, because we are closing off the interest expense. We debit profit and loss, and we credit interest expense, because we are closing or writing it off. So now that will be the sum of 61,875 plus 5,625. 625, which at the end give us the total of the interest expense as 67,500. So we debit here 67,500 and 67,500. So now that is requirement number 1. That is requirement number 1. You'll get your tick, your tick, your tick, and your tick. Then after you pass. That is out of 4 marks. Then after we go to the second adjustment, or the next adjustment, which that one will skip because it tells us about the calculation of the depreciation, the buying of an asset, and together with that one. So completely number D, I will not consider that. Number E says included in trade receivables is a debtor S. Smith who owes the corporation 6,000. He has been declared insolvent and received a check of 80 cents in the rand. So now the debtor owed the business 6,000 rands. Because the debtor was declared insolvent and we only received 80 cents of the check in the rand from his insolvent estate, and the remainder, which is obviously 20 cents in the rand, is irrecoverable, and they tell us that this has not yet been recorded. So now we have to write the bad debt. So now when we do that calculation, we need to say the amount of the debtor times by their percentage that was irrecoverable or that will not be received. And the debtor is the debt is the total of 6,000 rands. So now we have to say 6,000 rands times by 20% because we are looking for the bad debt side. So now we calculate our bad debt. I normally use the word bad debt as opposed to credit loss, but credit loss still means the same thing. 6,000 times by 20%. Remember, 20 cents is the same as 20%. I always emphasize that. So now when we say 6,000 times by 20%, that will give us the portion that was not paid back by the debtor because the debtor was insolvent or declared insolvent. Then that will give us an amount of 1,200. 6,000 times by 20%, that is 1,200. So now that is a bad debt, the portion that has not been received. So now we have to go and record that in the income statement under credit losses plus 1,200 rands. Then after we continue with the calculations, and in continuing with the calculations, let me go back, this thing automatically goes up. Then we continue with the calculations, and in the continuation of the calculations, we just have to say now, okay, this amount was not received, then another portion was received, and the portion that was received obviously affected our bank account. And remember, we don't do the bank account because bank account only affects the statement of financial position, and we don't do that statement as per yet. So now we have recorded the bad debts. Then the second part now of the transaction tells us that adjust the allowance for credit loss to 10% of the trade receivables. Okay, before I come here once again, I want to emphasize on what I've done previously. Here we know that the credit loss is 1,200. Just wanted to emphasize this 1,200. So now what I want to explain is the fact that it is not always the case that you'll be given a data and a certain percentage was paid and a certain percentage was not paid. It will not always be that case. Sometimes you can be given the amount of 1,200, which is the portion of the bad debt. So now if that is the case, you don't have to be calculating anything. You just take the bad debt 1,200, you add it to your bad debts or credit loss in the income statement. So now we come to the second portion again. Second portion says that we must adjust our credit losses to 10%. So now whenever that is the case, we just have to say, okay, our new allowance will have to definitely change. Our new allowance will be the total of the trade receivables that we have in the trial balance. And in the trial balance, we have our account receivables amount to 148,500. So now we have to say 148,500 minus 6,000 rands. Remember, out of the 6,000, 80% was received and 20% is a bad debt. So now the full amount is no longer a debtor in the business. That is 80%. The full amount is no longer a debtor in the business. So now that is why we remove the entire 6,000. So now that will be 148,500 minus 6,000 rands. That gave us 142,500. 142,500 times by 10%. And if we multiply this by 10%, it should give us 14,250. Then we say 14,250. We compare this with the allowance of the credit loss in the trial balance or rate, and I think that was the allowance, 8,250 minus 8,250 minus 8,250. That will give us an amount of 6,000. So now if you look in this allowance for credit loss, this is the allowance for credit loss, just to confirm. Allowance for credit loss 8,250. That is the old allowance in the beginning of the year, and you see that the date 1st January 2012. So now the new allowance and the correct allowance is 14,250. That means our allowance is increased or has increased from 8,250 by the difference to 14,250. So now we strike the difference, we check, and we found out that it is the difference of 6,000 rands. So now there we have 6,000 rands. That means our allowance increased by 6,000 from 8,250 to 14,250. Therefore now that means the estimate that bad debts will not pay back is increased by 6,000. So now the 6,000 will be recorded under the credit losses again in the income statement as plus 6,000 rands. Other lectures, they write the 6,000 separately, and they will write a line items here saying that increase in the allowance for credit loss. If you do that, you separate the 6,000, you are still correct. Don't think that I'm teaching my own thing. Your lecture will still mark you right. I just prefer this approach to my students, where they combine all these amounts. So now another part that is important regarding this 6,000 rands. Regarding this 6,000 rands, please take note of that. It's not a requirement, but it's just important, and you were tested on that, I think, also last term. Now after you have done the allowance, please be able to generalize this allowance or write a general entry on this allowance. And when you write a general entry, you debit bad debts by 6,000. That is why now I prefer to increase bad debts by 6,000. Then after you credit allowance for credit losses, allowance for bad debts, allowance for bad debts for an amount of 6,000 rands. So now that is how you generalize this entry. So now we have accounted for that also in the general journal. Then we can go to the next adjustment, and in the next adjustment we will have the rent expense, where they say that the rent expense is 2,250 per month and has been paid until 31st January 2013. Remember, the accounting period ends in December in the year 2012. So now the minute a rent of 2,250 is paid until January 2013, that clearly tells us that there is definitely a prepaid expense. So now if you say 2,250 times by 12, that gave us 27,000 rands. That means the business is supposed to have paid 27,000 rands of rent for the full year. So now, yes, we do see that 27,000 rands was paid, and here is 27,000 rands. However, another amount of rent was paid last year for the current year, and it was 1 month rent for the current year paid in the previous accounting period, and that rent was a rent of 2,250. So now it means the business in the current year supposed to have paid only rent for 11 months, because 2,250 was already paid last year. So now it means it was supposed to be minus 2,250. Then it means the rent that was supposed to be paid, actual cash, was supposed to be 24,750. But the business paid 27,000 rands. That is why I always emphasize to my students that all the expenses that you see in the trial balance are the expenses that were paid. All the expenses that you see in the trial balance are the expenses that were paid. That is the fact. In your current trial balance, the one that was paid. So now obviously credit loss is not a payment. So this 27,000 was already paid, as opposed to paying 24,750, because 2,250 was already paid last year for the current year. So now that definitely indicates that the difference between the two is 2,250, which is the prepaid expense at the end of the current year, which is being emphasized again now in this additional information. So now it means this is a prepaid expense. Remember, there was a requirement that we must do a ledger account for rent. That was requirement number 3, rent expense. So now in answering or to answer or to account for this adjustment, I will also answer the requirement. So now let us go and do the ledger account for the rent expense. So now in doing the ledger account for rent, we have to do the T account as usual. And we know that expenses increase on the debit side, they decrease on the credit side. And this is rent expense. We start with the total of rent that come from the trial balance, and the one that is 27,000 rands. And I told you that a reversal of prepaid expense must increase your expense in the current year. So now that 27,000 will have to be recorded on the debit side of the rent expense. That prepaid is a reversal. So now we debit our rent expense by 2,250. Contra entry will be prepaid rent. Then after, at the end of the year, there was another prepaid rent of 2,250. So now the prepaid rent at the end of the year is recorded on the credit side, while the prepaid at the beginning of the year is recorded on the debit side. Take note of that. It will never change. The one on the debit side is the reversal. The one on the credit side is the prepaid expense at the end of the current year. So now if we say 27,000 rands plus 2,250, that will give us 29,250 rands. 29,250 minus 2,250, that means we get to 27,000 rands. That will be P/L, which will go to profit and loss. So now the rent expense has been closed completely. So now it means under the income statement, we just need to subtract 2,250, because 2,250 is on the credit side, which is the negative side of the ledger account being rent. So now let us just go to the income statement and subtract the prepaid rent expense at the end of the current year as 2,250 minus 2,250. That will give us 27,000 rands of the rent expense for the current accounting period. Then we continue to the next adjustment. The next adjustment is number G, where we are told that Peter, okay, the next part was still under number F. Wages accrued on the 31st of December 2012 amounted to 109,750. So now it means the amount of wages that we see in the trial balance is underestimated by 109,750. The wages that we see here, 62,750, is underestimated because accrued means not yet. That means it's underestimated by 109,750. So now we just need to increase that 109,750 under our wages plus 109,750, because accrued expense at the end of the year indicate that it's an expense that was supposed to be paid but not yet paid. So now hence we have to add it because it was supposed to be paid by the current year. Remember, we recognize expenses that were supposed to be paid as opposed to those that were actually paid. So now I'll continue scrolling because this technology now always goes up for reasons I don't know. Then now we go to the next part, which is adjustment number G. Peter and Paul have agreed that a member's distribution of 75,000 must be made, which must be credited. Take note of this: credited against their interest-free loan account. That will be statement of changes in, that will be a statement of changes in equity. At the same time, it will affect the loans. Statement of changes in equity and the loans. Then the next one says provide for the income tax expense estimated to be 55,000 rands for the year ended 31st December 2012. So now we just have to record that 55,000 rands as a tax expense in the current year. Tax expense 55,000 rands. Now remember, when it comes to tax, you might be sometimes or randomly be required to calculate tax receivable or tax payable to SARS. So now we know that tax expense is 55,000 rands. So now when you are required to calculate tax receivable or payable to SARS, you'll say taxation expense. This again not a requirement, 55,000 rands. This again is not a requirement. I'm just elaborating on other important things. This topic you'll do it in details at second year. Taxation expense 55,000 rands. Then after you record provisional payment, and there was a tax that was provisionally paid during the year, and that provisional tax payment appeared there as SARS provisional tax payment, 67,000 rands 500. 67,500. 67,500. Let me confirm if I have all the amounts correct. Our tax expense is 55,000 rands and we paid 67,500. SARS provisional tax payment 67,500. So now we have overpaid in this case. So now if we have overpaid, we say 55,000 rands minus 67,500. That gave us 12,500. 12,500. That will be tax receivable from SARS, because SARS will have to pay us back. That will be tax receivable from SARS, 12,500 rands. This is not a requirement but important to understand. The next adjustment is the adjustment number H. Okay, we have done that one. Number I, due to old, that one is not important as per yet. I won't do it. So now we have covered all the adjustments. Then we can just totalize all the amounts in the income statement. Okay, finance cost, we did not take that into account. Finance cost, we had 5,625, although I wiped that away. It was 5,625. Remember, with regard to that, we said that 450,000 rands times by 15%, that gave us 67,500. Yes, I still remember. Then we said 67,500 minus the interest that was already paid, which is 61,875 minus 61,875. That gave us the 5,625. So that's where the 5,625 came from. And obviously the total must give us 67,500. So now the total will be 67,500. Sorry to forget that part. Now we can record all the expenses. Salaries to members remain 180,000 rands. There was no adjustment. Water and electricity remained 31,500. There was no adjustment. Wages will amount to 172,500. 172,500, which is the sum of 62,750 plus 109,750 and 172,500. Our credit losses, it will be 7,500 plus 1,200 plus 6,000 rands. That will be 14,700 rands. Then that will give us our total expenses. And our total expenses will have to be negative 504,450. 504,450. Then we'll say gross profit minus gross profit 642,500 minus 504,450. That will give us the operating profit of 138,050. 138,050. 38,050, which is operating profit or profit before finance cost. However you call it, you're still fine. Profit before finance cost. Before finance cost. Then we have finance cost. We subtract our finance cost. There is a line there. Whenever two amounts are subtracted, minus 67,500. That will give us 70,550. 70,550 minus 55,000 of tax. That will give us 15,550. Oh, what a small profit. 15,550. So now we have completed the income statement completely and it's 100% accurate. So now from here we can do the statement of changes in equity for a close corporation. And I have already prepared the template for the statement. And I have to start by saying statement of changes in equity for the year ended 31st of December 2012. So now we have to start with the opening balances. Remember, we had a total capital contribution that was 450,000 rands, which had to be divided into 55% and 45%. If you remember that. So now we have to say, okay, out of that capital contribution, which is 450,000 rands, how much was contributed by member Peter and by member Paul? The members' contribution is 450,000 rands, which they told us that it was based on their members' contribution. interest, their members' interest. Then we do that allocation, and we say 450,000 rands times by 55%. And when you multiply this by 55%, it will be 450,000 rands times by 55. It will be 247,500. 247,500, and 450,000 times by 45%, that will be 202,500. 202,500, which is 450,000 rands times by 45%. That is 202,500. So now that will be the members' contribution. We had an opening balance, okay, 247,500 and 202,500. Then we have opening revaluation reserve as 150,000 rands. There was no general reserve. Retained earnings is 375,750. Let me confirm those amounts for you. Revaluation reserve is given at an opening balance. Okay, first the retained earnings. Our retained earnings is 375,750. Here is our retained earnings, 375,750. That's why I took that. Revaluation reserves, we had our revaluation reserves is 150,000 rands, so that's why I took all those opening balances. So now we can have the total of our opening balances, and it is 975,750. Then profit for the period, we all know that is 15,550. 15,550. 15,550. That's small profit. There was no additional members' contribution. There was no transfer to general reserve, but there was a revaluation of land and building. And the revaluation of land and building was under this adjustment, revaluation of land and building. Checking for that. Prepare the statement. Okay, this were the requirements. Okay, there was the revaluation of land. They told us that the members revalued the land to the value of 1,275,000 rands. Number B. Therefore, now we have to go to the trial balance and we say 1,225,000 rands. Want to show you the calculations here. The land in the trial balance was 1 million. We have 1,125,000 rands, and when we continue, we see that the revaluation was 1,275,000 rands, then minus 1,275,000 rands, and the difference will give us the revaluation of 150,000 rands. So now that is the amount that will affect the statement of changes in equity. Under the revaluation, we record that 150,000 rands. it will be 150,000 rands. So obviously at the end the total will be 300,000 rands. Then that will not affect any column but the total column. And there was a distribution, and the distribution, I think it was 75,000 rands if my memory still serves me. 75,000 rands was the distribution that the members decided upon, and that was adjustment number which adjustment was it, where members decided to distribute portion? Adjustment number G. Peter and Paul have agreed that a member's contribution of 75,000 must be made, which must be credited against their interest-free loan accounts. So now that 75,000 rands will affect the retained earnings column negative in the statement of changes in equity, and there we have done so. So now with that being said, it means the statement is complete and done. So we have 247,500 and we have 202,500. We don't have anything under retained earnings. The total is 316,300 rands, and the total of the total is 1,066,300. Then the statement of changes in equity is complete and done. The last note that I will do now is requirement number 7. Requirement number 7 was to do the members' interest-free loans, which is number 7, where we had to do members' interest-free loans. This is a note. Members' interest-free loans. Members' interest-free loans. And under members' interest-free loans, we have two members, Peter, Paul, and the total is the sum of the two. We have the opening balances, and the opening balances of the loan are given from the trial balance. Let us check. We have 75,000 and 22,500. I think these were the two amounts because the total was 97,500. If I still remember those, total of the two was 97,500. Yes, the total is 97,500, which is 75,000 and 22,500. So now we write the total as 97,500. Then we record distribution credited. Distribution credited. That means the members are saying to the cross corporation, please don't give us what is due to us, but credit that to our loan accounts. So now what do? We take the amount of the loan of which, or the amount of the interest, their members' interest, and their members' interest is 55% and 45%. So now with that, we have to split the 75,000 using the members' interest. So now we just say 75,000 rands times by 55%, so that we get to the portion of Peter, 75,000 rands times by 55%. That will give us 41,250. That will be the portion of Peter in terms of distribution, and 75,000 rands times by 45% will give us the portion of the distribution from the side of Paul, which is 33,750. 33,750. That is the distribution of Paul. So now when we go to the note, we record those two. Then after, it will be the end of this exercise. So we record here 41,250. Distribution that is credited 41,200, 41,250. Then after under Paul we record 33,750. 33,750. Total is 75,000 rands. Then here we have a balance of total for this loan, 75,000 minus 41,250, 33,750. The second one will be 22,500 minus 33,750. That will be 11,250 negative, which at the end will be plus 33,750. That will be total of 22,500. Then with that being said, I've just completed this task. Thank you guys. I'm apologizing for the ups and downs because this technology was so up and down today. Thank you.